All right. Today is Sunday, July 18th. This is a recap for the market's activities last week and an outlook for the week to come. We start once again with the bond market mystery. Perhaps the main event of the year, the reaction of the bond market, which remains mystifying to economists and market observers alike. We say that because, on one hand, we have a vaccine-led recovery in the economy regarding reopening, etc. We also have a cocaine-led recovery via stimulus and endless flow of liquidity from the Federal Reserve. In addition, we have inflation, and we know that the first stages of inflation are extremely good for the economy and markets alike. Now, the expected reaction from the bond market given these facts, bond yields to surge significantly higher. And the expectations are, for at least the majority of market observers, were for yields to jump higher. And this is exactly what happened in the first quarter of the year. And then, as we started to enter May, June, and now July, the action in bond yields started to plateau, and yields actually went down. We are now trading at about 1.3%. which is well below the peak of 1.7% on the 10-year, of course. And this is contrary to the majority of market observers and economists alike. Now, we know that when the consensus overwhelmingly on one side of the argument, or one side of the argument becomes overcrowded, and in this case, bond prices go down, yields go higher due to the economic recovery and the endless support from the Fed. Combine that with inflation, the majority of market observers are in consensus with this view. But now that it is overcrowded, the likelihood that things will go the other way or to a surprising turn becomes extremely likely, because economists and market observers, including myself, by the way, we often forget about the blind spots in the mirror. And now we have this surprising turnout in the bond market, where bond prices continue to climb higher and yields continue to go down, even though we continue to get more information supporting higher inflation. Now, we know, suppose inflation gets out of hand and becomes a problem, the Fed will use its quote-unquote tools. One of these tools is tapering assets purchasing programs, including bonds. Now, when the sugar daddy who's been buying 50% of the bond supply in the market ceases to do so, the expectations are bond prices go down, yields go higher. And this is exactly what makes this move in the bond market extremely surprising and extremely peculiar. In uncoding the move, we have explored many different possibilities. We started by brushing it off as quote-unquote taper tantrum, and then perhaps the technicals, and even the possibility of an upcoming stagflation. We know that we should always trust the bond market. Always trust the yield curve. And the yield curve, the bond market are telling an extremely important story. But is it still a taper tantrum several weeks after the Fed's decision, the hawkish stance, so-called hawkish stance? Because we know that they have reversed the so-called hawkish stance 180, and they continue to flip-flop back and forth. Is it really the technicals, when the technicals themselves are also getting overextended and overexaggerated? Perhaps, but this argument is starting to weaken also. Is it stagflation, when the economy is still recovering jobs and we have over 9 million jobs openings? Or is it stagflation when we have a number like retail sales, which we got on Friday, surprising everybody to the upside? We're not in stagflation yet. It will happen if the Fed continues on the same policy. So this argument also starts to lose some ground. And we are now left with two important arguments. The tapering argument, which is a temporary reaction. You can combine that with the taper tantrum argument, but in this case, the argument goes, we are in a Fed-supported market. Once that support is lifted or starts to shrink, then the so-called economic recovery and economic growth goes out of the window. And this is what the bond market is predicting, at least for now. Perhaps when the tapering actually happens, yields go back higher. But the tapering argument is gaining a lot of ground. The other argument is the delta argument. And is Delta getting out of hand? Not really, at least not in the United States and the European Union and highly vaccinated nations, at least not for now. But is the bond market seeing something that we are not seeing? That remains to be determined. But what we know is the state of confusion coming out regarding these two issues, tapering and the virus/vaccines. Let's start with tapering. The uncertainty comes from the constant flip-flopping by the Federal Reserve. One day they take a hawkish stance saying they might taper, and the talking about tapering has already started, and then the very next day when the market reacts negatively to this hawkish stance, they flip and say forget about it, we're not going to taper until our quote-unquote goals are met. We will remain accommodative, yada yada yada. Take for example this week when the Consumer Price Index, also known as the CPI, came out too hot. Expectations were that the Fed will taper sooner than expectations because the number makes the so-called base effect argument, aka the transitory argument, weaker than before. The market reacts in a certain way. The very next day, the Fed chairman comes out and says, forget about it, the economy is quote-unquote way off from tapering. And then, as he get under pressure the very next day from the Senate telling him, hey, what are you looking at here? Are you looking at the same piece of information that we're looking at? One of the hottest CPI numbers on record, the highest PPI number on record, the highest Empire State Index on record. Are you looking at the same data that we're looking at, Mr. Powell, or not? And Powell flip-flopped once again from way off to we are actively considering tapering.
Inflation is well above target, and we've discussed that. And we've said that we would begin to reduce our asset purchases when we feel that the economy has achieved substantial further progress measured from last December. So we're in active consideration of that now. We had a full meeting last month to discuss that. We've got another meeting coming up in 2 weeks. So we'll be making that assessment.
And by the way, the confusion doesn't start or stop here. The confusion starts from the core argument. The Fed says we want inflation to average at 2%, but we're not going to use any guideline or any formula to determine where inflation should average at 2%. What is too much or too little inflation for that average to happen? We're just going to eyeball inflation.
In seeking to achieve inflation that average % over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting.
And of course, this doesn't give the market any assurances that the Fed is indeed in control of inflation. Furthermore, we have conflicting views from Fed presidents themselves. Take, for example, the San Francisco Fed President Daly. She says that inflation will ease off. Don't worry about it. On the other hand, you have St. Louis Fed President James Bullard, who says perhaps we have already reached our goals in inflation and the unemployment rate, and it is time to start tapering now. Once again, no consensus, no guideline from the Fed, leaving the market in a confused state. Now, let's move on to the Delta argument and the confusion from that particular argument. Do we trust shoe polish Dr. Gottlieb, who says to his wife every time he wakes up, honey, do I have enough shoe polish on my hair, or do I need a little more? And of course, the irony is the source of confusion and lack of trust from the public regarding the virus and vaccines is the fact that this guy, every time they introduce him on TV, they say former CDC commissioner, and we have to disclose that he is currently a Pfizer board member, Dr. Scott Gottlieb. Now, let me ask you a question. When you hear this sort of introduction, former CDC commissioner, current Pfizer bitch, do you really trust this guy? Or do you start to question the revolving door policy in our politics? You serve for a few years, you do favors for corporate America, and when you graduate from your position, whether you're a CDC commissioner, FAA, FDA, doesn't matter. You do the job for Wall Street and corporate America. You graduate, and they reward you with millions and millions of dollars in quote-unquote consulting positions, board member positions. What a joke of a system. So once again, do I trust shoe polish Gottlieb, or do I trust Pfizer, who say we now need a third booster shot? Or do I trust Fauci, who says, no, you don't need a third booster shot. If you are vaccinated, you're safe, you're okay. Don't worry about it. And by the way, shut your mouth and go get the vaccine. Or do I trust the CDC, who say if you're immunocompromised, perhaps you need a third shot from Pfizer? Or do I trust the data from Israel and the UK showing that the AstraZeneca vaccine is actually not that effective at all when it comes to Delta? Likewise, the Pfizer vaccine also loses efficacy against Delta, but the good news is it prevents severe illness and hospitalization, at least for now. Our CDC here in the United States of America, our public officials, they're not even willing to discuss the efficacy of the vaccine against Delta, debating the data coming out of Israel, producing their own data. They don't want to bother at all. Just take the vaccine, it works, shut your mouth, and we'll talk about Delta later. This is causing a lack of trust from the public to get the shot, and uncertainty in financial markets regarding what we know and what we don't know regarding this new strain of the virus. Let me give you some examples here regarding the confusion, not just for us, the public, but also for markets. This is from the same video, the same segment from Good Morning America. And notice the contrast.
This morning, the CDC announcing 32% of Americans still have not received a single dose of the COVID vaccine.
This is becoming a pandemic of the unvaccinated.
And now there are more reports about breakthrough infections among fully vaccinated people. This Oklahoma couple say they were fully vaccinated but fell ill after a recent Vegas trip.
It felt like concrete was inside of my face. Immediately, I thought this could be COVID, even though I had been vaccinated.
So here it is. On one hand, you have the CDC commissioner saying that this is a pandemic of the unvaccinated. And right away, we get a story of a fully vaccinated couple getting the virus on a trip. What do I believe? Who do I trust? Who does the market trust when it comes to the transparency regarding the efficacy of the vaccine against Delta? Clearly, with no doubt at all, from the data we know for now, the facts that we know for now, the unvaccinated are more threatened by the Delta variant than the vaccinated. But how effective is the vaccine? Is it losing efficacy by time or due to the new strain? A major issue to distinguish from. Are the vaccines losing efficacy due to time? And we know that Israel was one of the first countries to get vaccinated. Or are the vaccines, in this case Pfizer, the mRNA, including Moderna, by the way, losing efficacy because the new strain is managing to evade the antibodies from these vaccines? Who knows? We have no clue at all. At all. We know for now the increase of cases in the United States is coming from states that have less than 50% of the population vaccinated. But we also have an outlier in Rhode Island, but this is an outlier at least for now. So what we know for now is the bulk of the problem is within the unvaccinated. But here is where the confusion starts. I'm going to read headlines for you just so you can understand the dilemma of the market. What to make of all of this data. Here it is. And this is from the Boston Globe. 79 fully vaccinated Massachusetts residents have died. 303 hospitalized in very rare COVID-19 quote-unquote breakthrough cases. Another headline from Chicago. 2% of COVID death in Illinois this year have been fully vaccinated residents. Here's another one out of Las Vegas. COVID outbreak among vaccinated Vegas hospital workers underscore Delta risks. Here's another one. Delta variant key to breakthrough infections in vaccinated Israelis. What are they talking about? Here it is from the Jerusalem Post. Pfizer COVID vaccine significantly less effective against Delta variant. Here's another headline from Insider. Almost half of UK COVID infections are in people who are at least partially vaccinated, study suggests. But the cases were much milder. Another one. You can catch the Delta variant when fully vaccinated, but symptoms will likely be milder or non-existent, data suggests. Who do we believe? Forget about the market. We're talking about the public. And this is becoming a major problem. The public's mistrust regarding the information we're getting out of the government for the virus and the vaccines. From the beginning, the lethal mistake the government has made is politicizing this issue. Just imagine this. We have the most dangerous, deadly pandemic in at least a century, infecting and killing millions of people. And you say, hey, you know what? We found out a vaccine that will make the virus less deadly. And the government has to scare people or even force them with propaganda to take the cure? How did we get to this point? The massive mistrust from the public that is now morphing from a health public crisis to an economic crisis, and the bond market is saying that exactly. We got here because the government decided to politicize the issue. This is the lethal mistake from the government. Of course, we know that the person who started this politicizing is former President Trump. He made egregious errors and mistakes that perhaps cost a lot of lives. And after that point, it became either your team Trump or team Dr. Fauci. The issue has become extremely polarized when it shouldn't have been at all. Okay, fast forward. We're now at a new administration, the Biden administration. Did they do anything differently to remove the mistrust and become more transparent? Perhaps creating a committee from the CDC, NIAID, and scientists trusted by the majority of the public from both sides of the political spectrum? Of course not. The Biden administration continued with this propaganda-like effort, which is actually acting as a deterrent for those who are already skeptical about the vaccine from ever taking it or even considering to take it, because the issue is being politicized once again. The Biden administration invites Olivia Rodrigo to do some propaganda on their behalf, hoping that the public will trust Olivia Rodrigo and take the shot. Furthermore, using somebody like John Legend to tell us that this is quote-unquote our shot and take it and you'll be fine. Well, John, I take my shots differently. We don't need all of this propaganda. We need the facts and the science. Release all the facts, all the science, what we know and what we don't know, and people will make the right decision. But politicizing the issue is the lethal mistake here. And now we have Biden blaming Facebook for the misinformation and accusing Facebook of quote-unquote killing people.
They're killing people. I mean, it really, look, the only pandemic we have is among the unvaccinated, and they're killing people.
Is Facebook really to blame for the amount of misinformation, or is it the fact that the government made a major error, a lethal mistake of politicizing the virus and the vaccines from the very beginning, and did not offer any remedy to repair the broken public mistrust that led people seeking the quote-unquote truth in the dark alleys of the web, including Facebook? The government created that void. The sloppy job that they did is to blame, not Facebook. The other thing I want to talk about now that we have addressed the bonds market confusion regarding tapering coming out of the flip-flop from the Fed, or regarding the bond market confusion from the Delta variant, which is caused by the government not being transparent and managing this the right way from the very beginning. Let's talk about this documentary by Frontline, PBS. It's called The Power of the Fed. And I highly recommend that you watch this one, because for a change, the media is actually reporting the truth, in this documentary at least, about the Fed, opening the argument that perhaps the Fed's policy is misguided and it only succeeded in creating wealth inequality and homelessness in the country. But as I said in a tweet, this is a proof that Neel Kashkari is Satan. In the documentary, Mr. Kashkari, who is the Minneapolis Fed president, says yes, the Fed's policy of enacting quote-unquote emergency accommodations for the stock market and Wall Street since 2008 might have created wealth inequality and favored the 1%. But at the same time, he credits their policy of recovering and creating jobs in the aftermath of the financial crisis in 2007-2008, which is pure propaganda, by the way, and it shows the evil genius that is Kashkari.
In our conversation, Kashkari was quick to dispute the criticism that the Fed is really just boosting financial markets and helping Wall Street.
There is this idea on Wall Street that the Fed kind of has our back, and that because you may have well-intentioned policies that are trying to get everybody to work, there is this side effect, this unintended side effect of just kind of really helping the rich.
That argument ignores the benefit to the poor. And if you're going to ignore the benefit to the poor, then we're only helping the rich. But of course, that's an incomplete analysis. When you actually sit down and say, well, let's go through the trade-offs of the choices that the Fed has, whether it's interest rates or it's quantitative easing, it's not just about Wall Street. It's not just about asset prices. It's also about thinking about the men and women in America who are trying to find work and who want to have higher earnings and who deserve higher earnings. If we are benefiting them by helping them find work and helping them have higher wages, I will take that trade-off.
Of course, Neel is a different breed from other Fed presidents because he's a man of the people. He has a Twitter account and he comments and debates on issues from time to time. Of course, until you start outsmarting him and challenging his views, he will resort to blocking you on Twitter, just like he did with me, because Neel Kashkari is afraid of debating people who can outsmart his propaganda. And by the way, it's not too hard to outsmart Neel Kashkari. He might be an evil genius, but he has the intelligence of a mule. Because saying that, and you can read the comments on the video, by the way, most commentators are pointing out the flawed argument by Neel, which I refuted, by the way, in the previous video on this channel, in which I showed you Fed Chairman Powell admitting that it took over 8.5 years for the economy to reach 3.5% unemployment after the financial crisis over a decade ago. So was the Fed's policy of accommodating Wall Street really responsible for creating jobs, since it took 8.5 years to get to 3.5% unemployment? Or are there other factors that led to the recovery in the jobs market? And is it even a good policy, hypothetically speaking, assuming that it is effective in creating jobs 8.5 years later, all the way to 3.5% unemployment rate? Is it really worth it? Is it really the best policy out there to print money for years and years and years, and 8 years later you reach 3.5% unemployment? What is the side effect? What is the cost of getting to 3.5% unemployment 8.5 years later? Well, the cost is making the rich richer, distorting all price discovery methods and valuations in the equities market, creating insane market rallies benefiting the 1% who happen to own stocks and real estate. Is this really the best policy and the best approach to recover jobs, Mr. Neel Kashkari? Or perhaps that the Fed's policy of accommodating Wall Street with emergency measures, of printing money out of thin air and conducting the cocaine operation of assets purchasing, specifically bonds or mortgage-backed securities. Perhaps this policy has nothing to do with jobs creation. Have you ever thought of that, Mr. Neel Kashkari? Can you provide any proof that buying $120 billion a month in bonds and mortgage-backed securities by the Fed creates any job? Can you provide any proof for that, Mr. Neel? Can you provide for me any evidence on how buying Apple bonds, the wealthiest company in the world, by the Federal Reserve has created a single job? Can you provide this evidence, Mr. Neel Kashkari? Can you provide any evidence that after the trillions of dollars that the Fed has added to the balance sheet since last year, not years ago, last year, can you provide any evidence that those trillions of dollars have done significant impact in recovering jobs? Because as far as I know, we still have a high unemployment rate. But this is the propaganda and this is the evil genius of Neel Kashkari. But once you start asking him hard questions, you realize that the guy has no intelligence at all. And of course, this is why he avoids real questions. He likes the easy questions. But of course, Neel understands the suffering and the plight of the poor and the homeless, because he pretended to be homeless for a day. He staged being homeless for a day, and now he understands the suffrage of the poor. And therefore, he's not against the Fed's policy because they help the poor. They create jobs 8.5 years later. Oh, and by the way, the Fed's policy makes homes affordable. What a joke. What a joke. Now, of course, we know that Neel Kashkari is actually a multi-millionaire who lives in a mansion with dogs and nice cars. And the guy feels invincible. Why? Because in this country, politicians cease to fear the people. Politicians have their careers set on stone. They don't even bother to campaign in certain states. They get their seats by default. And what makes the matter worse is the fact that Neel Kashkari and Fed presidents, including the Fed chairman, are not even elected. They're appointed. They're appointed by the real rulers of the country. Let's move on to some of the data we got on Friday. Most importantly, retail sales.
Yes, survey says our June read on retail sales, and we all know maybe the most important number here is going to be ex-autos because of some of the issues regarding supplying, building automobiles. And of course, I'm talking about this because the data hasn't quite come out yet. Here, we're starting to see it trickle out, I should say. So if you look at the headline, we're expecting actually a down number, but that isn't the case. This is kind of surprising. Right now, I see up 0.6% on headline retail sales. We're expecting a number down 0.3 or down 0.4. Ex-autos, all right. The ex-autos up 1.3. This is 3 times what we were expecting. And if you strip out autos and gas, it's up 1.1. These are really, really strong numbers. As a matter of fact, that ex-autos up 1.3, well, that's the best since March when it was up 9.8, but it really is significant. And on the sales control group, retail sales control group, this number is plugged into other more important numbers up the economic food chain. That is up 1.1, also about 3 times more than expectations.
And boy, this was a massive upside surprise, even to me. And as I said in this tweet, the upside shock, the upside surprise number in retail sales is an indicator that this is not just a supply, quote-unquote, bottleneck story. And once the supply catches up with the demand, we're not going to have inflation, and therefore inflation is transitory. This is also a demand story that will prevent supply from ever catching up to the demand. And the reason is the demand hasn't stopped growing, and it will not stop growing so long as the Fed continues to print, handing the cash to the government, and the government handing some cash back to the consumer. The cash will be spent, all of that stimulus is continuing to add to the demand in the economy. And supply will have a hard time catching up, closing the gap when the demand continues to grow higher. And of course, this will have ramification in the market. A number like we got on Friday will excite investors to move towards stocks that are consumer brands. McDonald's, Starbucks, Target, Procter & Gamble. And these are the stocks that managed to outperform this week. There are fundamentals supporting the market action. Anyhow, let's move on to some market news. Market impacting news. Over the weekend, we got news from OPEC. And now we have an agreement, a formal one between OPEC members. And they have agreed to increase the supply in the market by about 2 million barrels a day, which is a significant quantity. And this increase will be shared by an increase in output from Saudi, UAE, Iraq, Russia, Kuwait, and other countries. The question is, will countries that are not included in this round of increase in output get mad and demand to increase their outputs too? Because if this is the case, then we will see a race to the bottom in oil prices. Because remember, you have to thread the needle extremely carefully here. On one hand, you want to avoid the risk of oversupplying the market, where we have the uncertainty of delta slowing down the demand, and you risk oversupplying the market. You also have to thread the needle to avoid oil prices from going extremely high. For example, if crude oil prices reach $100 a barrel, this will create a lot of headlines, catch the public attention and the Biden administration attention. And if oil prices go too high and Americans pay more at the pump, significantly higher than right now, perhaps this will reignite the shale oil boom. And this is the last thing OPEC members want. Therefore, you have to thread the needle extremely carefully. But for now, my sentiment on oil prices are waning down a little due to the delta threat to demand, and now we have an increase in supply. Lastly, before we move on to charts, let's go over the heat map. And this is the heat map from Friday. As you can see, both the inflationary and disinflationary trade all underperforming. What's performing? The defensive side of the market, the real defensive side of the market. Not technology, not Apple, but dividend-paying stocks. We're talking about the utilities, REITs, healthcare stocks, specifically the big drug manufacturers, in addition to consumer defensives. Of course, energy and financials pay a lot of dividends, but once again, these sectors of the market are not defensive. When the bond market is expecting economic deacceleration by dropping yields down, well, guess what? Financials and energy also get hurt. But when the market resorts to utilities, REITs, and defensives, it tells us that the psychology and the sentiment in the market is changing from bullish to perhaps bearish. When we look at the weekly heat map, you can see that big cap technology names outperformed in general for the week. We're talking about Apple and Microsoft, but again, they're not the defensives that are working right now in the market. For the week, we saw names like PepsiCo, Coca-Cola, Procter & Gamble, United Health, REITs, utilities, closing higher. These are all defensive names. So the market is shifting from the offensive to the defensive formation. And this is an important clue to take home because it will impact your portfolio. If the market is shifting from offensive to defensive, you got to change your strategy. This is just 1 week worth of activities, but the evidence is becoming clear. When we switch to the weekly ETF heat map, the evidence becomes even clearer. You can see the outperformers for the week. These are the inverse indices, the SQQQ, the SPXU, the SDOW, in addition to VIX proxies, the VXX, the UVXY, and then we have underperformance from technology, whether it is the XLK or even chips, the SOXX, the SMH, all underperforming. So was the inflationary trade performing at all? Of course not. Financials were down. XLF, KRE getting whacked, energy, the XLE, the XOP also getting whacked. Likewise, metals, materials, the XME getting whacked. Bloodbath across the board. Meanwhile, in contrast, the ETFs lighting up in green, meaning that they managed to close higher for the week. We have the XLU, this is for utilities. We have the XLP, this is consumer non-discretionary, meaning defensives. And even the XLV, the healthcare sector of the market, also outperforming, even though closing slightly on the red. Pretty much flat, but flat was good this week. Flat was outperforming the market this week, and the XLV managed to outperform. But this is a defensive formation, 100%. We will see if it lasts this upcoming week and as we get deeper into earnings season. Anyhow, let's move on by covering some charts. Starting with the 30 minutes chart of the SPY. We had a gap higher, believe it or not, in the morning on Friday, and that was perhaps some short covering, because the market did a 180 right away, flushing down and closing at the lows of the day. Where do we stand here? We had the double top formation of 432. That was the clue that we're not going to go higher because we struggled twice to break above 432. The negativity continued to build on and the bears gaining significant advantage as the chart started to move down to the support level of 434. We saw some bounces from an intraday level activities attempting to hold the 434. Not once, not twice, but multiple times. Eventually, the chart breaks below 434 and trades there for about 30 minutes or so. Immediately, we saw a bounce, a reversal candle, and the chart closed the day above 434. So for those bears betting that the floodgates will open the moment the SPY cracks below 434, they got caught in a bear trap. So in the morning, they started covering. And what do you know? They were wrong because more sellers hopped in the ride and pushing the chart significantly to the downside. There was a battle for a moment or so to recapture 434 for support. But once the chart started to pull away from 434, that was the warning signal that 434 will not work and the chart will see a roller coaster down. It went all the way down and the support I was eyeing is 430.5. But remember, there is a gap slightly above 430.5. The chart goes all the way down to close the gap and catching support from closing the gap. At least for the week. Can we trust that the gap will act as support? I don't think so, at least not for me. I want to see a solid bounce from 430.5 and perhaps recapturing 434 as support, and then I'm ready to say that we have a bottom and the market will go higher. Absent of that, this is a weak support. The gap at even 430.5 is also weak support because, as you will see in the daily chart, the momentum indicators are deaccelerating quickly. They're falling down quickly, indicating that the sentiment and momentum is shifting away from bullish to bearish rapidly. And here is the daily chart for the continuous contract for the SPY. Once again, when we look at the momentum indicator, the negative divergence was the warning shot. And now we see that the negative divergence is playing out and the RSI is trading down. Likewise, the MACD indicator is already trading down, making a crossing and creating a red impression on the histogram. If this is the case, then we will see a reversion to the mean in the MACD. and that will perhaps coincide with the continuous contracts chart to go down all the way to the support level of 4,232. And this will be about 3.5% correction from the top, which is normal. The market has corrections, just in case you did not know that. In case if you were born yesterday and you joined the market last year, yes, we have corrections from time to time. And 3 to 4% correction, that's nothing. That happens all the time. And by the way, what is the equivalent level on the SPY's chart? I'm looking at 423. This will be the target if this correction continues throughout next week. What about the Qs? The Qs has a bigger problem than the SPY. We have a double top formation. The chart failed to keep the support of 363, flushing all the way down and failing to catch 360.5. We saw the gap higher, some short covering, because you have to remember, the bears are traumatized. The bears have been wrong every time they shorted the market. So when they short and they finally hit, they score some gains, of course they're rushing to take chips off the table. They're traumatized and they lack confidence. So we saw some short covering in the morning, but once again, more shorts and bears piling in, more sellers than buyers, and we see the market failing the support 360.5 once again. Now, why do I say that the Qs has a bigger problem than the SPY? The reason is we know that the next support for the SPY is about 3.5% downstairs. But when it comes to the Qs, the support is way down there, more than 6%. Downstairs. So the correction in the Qs could be more severe than any correction in the SPY. And here it is when we zoom out. We're still using the 30, by the way. We're just zooming out a little bit. The next support is all the way down to 344.5. This will be a bigger correction. Of course, we have gaps, as I'm highlighting in these yellow bubbles. These are all gaps. Filling those gaps should act as support. But again, you have to remember that this is soft support, not a hard support. And the reason is the chart did not spend significant time at these levels. And by the way, before we move on from the Qs, let's talk about a day trade that I initiated on Friday. I'm not a day trader. I don't usually do day trades, but this one was handed to us on a silver platter. This is a 5 minutes chart, by the way. And as you can see, the Qs breaking the support of 360.5. You can use 360 for simplification. The chart flushes down, then rebounding to attempt to recapture 360 for support. It fails again. It gathers some energy. You have the second attempt at cracking above 360 and yet failing once again. Immediately watching this price action, you know you have a double top formation, a double rejection formation, which is usually followed by a flush down. You place the short, you have the flush down all the way till the end of the day, you close the trade and you take profits. It's about $3 profit, but again, for a day trader, for the quantity you're going to trade, this trade reaped significant profits. Moving on to the daily chart of the continuous contract on the Qs, the Nasdaq. Once again, the momentum indicators are weakening. We have a negative divergence in the RSI. We have a negative crossing in the MACD indicator. And the candlestick pattern is also reversing. We have a confirmation for the reversal all across the board. The candlestick, the MACD, the RSI, all have confirmed the reversal from bullish to bearish. The problem with this chart, as I illustrated before, is the fact that we have a massive sinkhole before we get to the support of 14,000. This will be about 7% correction in the Nasdaq from the top. And therefore, you look at the SPY, you might go down 3.5%, 4% at the max. But in this chart, if we go back all the way down to the support, then we're going down fast, baby. We're going down all the way 7% till we get to 14,000. What about the IWM 30 minutes chart? We talked about the short covering in the morning. I actually expected some short covering in the IWM in the morning because it has been underperforming both the SPY and the Qs for a while now. The IWM small caps, the Russell 2000, has been on a downtrend for weeks. And in this market, when shorts score massively in a trade like this, you would expect some short covering and profit taking at the support of 218. This happened for about 30 minutes or so in the morning, but more shorting and more selling followed through, and you saw the IWM even rejecting 218 for support. There is extreme bearishness here, and we are all aware of the correlation between the IWM and AMC. AMC has a huge weighting in the IWM. And AMC had an awful week, losing double digits. And this has hindered the ability of the IWM to climb higher, even though throughout the week we saw days where cyclical names in the IWM were outperforming. But the underperformance from the meme side of the IWM was overwhelming here, and we saw the IWM closing down for the week. If this is a leading indicator, then we have more pain coming from the SPY and the Qs. And where is the next support for the IWM, you might ask? Here it is. We're going to zoom out a little bit and we see 212 as the next support. This is a messy chart with a lot of notes, but I have 212 for support. This was the previous double bottom and it should act as support and a bottom at least for now. What about the Dixie? Here it is. The technicals are topping. The technicals are getting overextended. But it is the battle between technicals and fundamentals. The fundamentals say, watch out, the Fed will have to taper sooner than expectations, and the Dixie goes higher. This makes this chart of the dollar index the most important chart to watch in the market right now. There is no other more important chart than the US dollar, because if the Dixie breaks above 93, number one, we're going to have significant pain in metals and in commodities, but it will be another signal that the tapering will happen this year with 100% certainty. Yields will go down, perhaps breaking the support of 1.28, 1.25 in other charts, and perhaps we will start to see dollar-sensitive stocks underperforming in the market, switching to yields, the 10-year yield popping higher after the CPI, reaching the resistance zone, getting rejected, and doing a 180 and then some from the reaction to the CPI report. Now, let's review the facts. Did the CPI surprise to the upside or to the downside? The answer is to the upside. Did the PPI surprise to the upside or to the downside? The answer is an upside surprise. Did the Empire State Index surprise to the upside or to the downside? The answer is we got the hottest reading in record. Did retail sales on Friday surprise to the upside or to the downside? The answer is an upside surprise. So inflation and growth continue to rise higher. Why are yields reacting negatively, reacting opposite of how they should react giving the information? That makes the mystery. And for now, the strongest possibilities for an answer is the tapering impact and the reaction to the Delta threat. The level I'm watching here is 1.28 basis points. Violating this particular level will open the floodgates. And by the way, if we go down below 1%, this will create headlines, negative headlines, and we will see panic in Wall Street. This is the weekly chart of the TLT bond prices, again closing the gap, then a 180 closing at the highs of the week, short of 149. But if the bond market continues to react the same way, it is just a matter of time before the TLT cracks above 149. And this is exactly the psychological level that bond longs have been playing for as a trigger point for short covering and a more confident rally. What about the VIX 4 hours chart? We are watching the MACD indicator. We have a positive crossing, meaning that we have a rally on our hand for the VIX. How far would the rally take us? This remains the big question. Most importantly, will it take us above 20? Will the VIX closes the week above 20? We will see. But so far, it is shaping as the VIX will pop above 20, and this will be a reaction to the SPY falling down to support at 423, 425, a correction about 3.5%. What about Apple? 30 minutes chart. This has been the market-defying stock, single-handedly holding the market on its shoulder. But that weight is becoming too heavy. Even Apple cannot hold the market alone. And as we started to see the last few days of the week, the market shifted from defensive to extra defensive. Defensive level number one is go back to the FANG names, the big cap technology names, and you'll be fine. But defensive stage number two is we go back to yield dividend paying stocks in REITs, utilities, defensives, consumer brands. And then we have stage number three for defensive, which is going all the way to cash. We're not at that point yet, but how long will it take us? In the case of Apple, since we're shifting from stage number one to stage number two of defensive, We have a negative trend on the chart and weakness for Apple, which will be confirmed, by the way, if the level of 145 is violated. But once again, I'm not expecting a massive flush down in Apple unless we get to earnings. It will be surprising if Apple drops down 3 to 5% prior to earnings, but we'll see. What about Tesla? This chart is becoming a day trader's dream because we have a defined resistance, support, and a bull to bear advantage line. The resistance is at 679. The support is 629. The bull bear advantage line at 657. The chart is trading below this number. So we know the bears have the advantage for now, but their advantage will be confirmed once 629 is broken as support. For now, the bears have the advantage in the souffle. What about BTC, tulips? What's going on here? 30,000 is not broken yet. We're still trading above that level. No problems for now, but it is starting to melt down. The question is, how long will it take before we see the floodgates opening below 30,000? With that being said, I still admire the resilience of the laser beams who are keeping BTC trading above 30,000. There is one risk to the upside, by the way, just for you laser beams, because I love you and I cheer for you. The risk to the upside is the consensus. The so-called overcrowded trade is becoming short BTC and assume that 30,000 will not hold the support. What if we get an out of the blue positive catalyst for BTC? Elon Musk pumping again, somebody else bought BTC, some other country legalized the use, whatever. What if we have a catalyst out of the blue and we see lots of short covering in BTC? It will be a significant one, by the way, and this is the upside risk for BTC right now. But once again, the bears still have the advantage here. What about AMC? You want to talk about bears and apes, zoo animals? This is the chart to look at. We talked about 32 as support, filling the gap, and indeed it acted as support, and the chart closed the week above 32. But we don't have a decisive rebound, a decisive bottoming formation yet, which opens the risk that 32 will not hold as support. And I issued a tweet and I told you that I closed my long trade in AMC, which is buying the 36 calls, selling the 37 calls, and it was a day trade. It reaped significant profits, but after that point, AMC made a 180 trading to the downside, and this is an illustration that the chart does not feel confident of 32 as support. Wants to go down once again and retest 32. My assumption is another retest for the 32 will not hold, and we will see the floodgates opening at that point. Here is the weekly chart for AMC, and this is perhaps the scariest chart I can see in the market right now. Number one, retail traders already lost a lot of money. Anybody who bought above 35 is already underwater. Anybody who bought below 35 are starting to get nervous. The psychology is important, and when combined with the technicals, for example, in this chart, a weekly chart of AMC, the momentum indicators are slowing down. We have a negative divergence, a negative trend starting in the momentum indicators. If we have a reversion to the mean scenario in the MACD indicator, this means that the chart will also revert to the mean as the momentum starts to wind down. And the reversion to the mean will be all the way down, in this case, to about $10 a share. Because the selling will snowball if the apes start to lose the psychology battle. If they become afraid and they rush to book whatever profits are left or minimize the losses in their banks. It is called evolution. Anyhow, moving on to the conclusion of this video. What do we have on the economic calendar this week? It pales in comparison with last week because we had the CPI, PPI, Empire State, retail sales. This upcoming week, we're going to have some important data, but not as important as last week. Monday and Tuesday, we're getting data regarding the housing market. Thursday, per usual, we have the initial jobless claims for the week, and again, more housing data, existing home sales. And on Friday, we're going to have the flash PMI, the manufacturing and non-manufacturing PMIs. The likelihood is we're going to have a confirmation to the data we got from the Empire, Philly, and the Chicago PMIs. What about the earnings calendar? We're getting deeper here, folks. On Monday, we have IBM. Tuesday, United Airlines, Netflix, and Chipotle. Wednesday, we have Verizon, Coca-Cola, Johnson & Johnson, Las Vegas Sands, and Texas Instruments. Thursday, we have Freeport-McMoRan, AT&T, Intel, Snapchat, Twitter, American Airlines, and Southwest Airlines. Lastly, on Friday, we're going to have American Express and Honeywell. A stealth outperformer in the market, Honeywell has been rallying quietly for a long period of time. On Friday, we will get the moment of truth for this stock. Anyhow, folks, that's all I got for you for now, and I will talk to you again tomorrow.
To the person who is about to grab their car keys and go to the ATM and take out $3,000, you say what?
You don't need to. Your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. An infinite amount of cash at the Federal Reserve.
An infinite amount of cash at the Federal Reserve. An infinite amount of cash at the Federal Reserve.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.